So good morning. It is another beautiful morning. Sun is shining again, clear day, good day for you to go out and take a walk a little bit later. And my name is Todd Polinak. I'm a partner at Sachs and welcoming you to our Preparing for Recovery, Managing Forgivable and Unforgivable Loans this April 16th, 2020. Yes, so we are broadcasting live from New Jersey. So if you hear some background noises, that's coming from our homes. Hopefully the fire department doesn't release another alarm or dogs bark, but just bear with us. This is our slide that basically tells you that this webinar presentation is for general guidance only, and it doesn't constitute the provision of legal advice, tax advice, accounting services, etc., etc. Consult your professional advisor concerning those specific situations that you need answers on, but happy to present this seminar this morning. And here is our agenda. Introduction. So that's what we're doing right now. We're going to be talking about the Main Street Lending Program, which is the Main Street New Loan Facility and the Main Street Expanded Loan Facility. We're also going to talk a little bit about the key PPP and EIDL takeaways and considerations. And we're going to wrap it up with loan forgiveness, something everyone is asking the question about. These are us. You can see myself here, Todd, Josh, my partner Josh, my partner Stephen. We are definitely not dressed as you see here. I don't know what Josh and Steve are dressed in, but I'm certainly not in a suit. But we're glad to be here on this wonderful Thursday morning. Going to kick it off to Stephen, who's going to talk about the Main Street Lending Program. Stephen, take it away.
Thank you, Todd. Good morning, everybody. It's April 16th, typically a fairly relaxing day for those of us in the tax profession, but different times call for different measures. And so I'm sure everyone is busy now with the loan forgiveness and also other lending programs that are out there. So before we get to the forgiveness portion, we're just going to talk about the new facilities that were recently issued by the Federal Reserve. So if you haven't seen, about a week ago, the Federal Reserve took a historic $2.3 trillion action, basically releasing a number of funding programs and credit facilities designed to add liquidity to our economy. These are aimed at households, small to mid-sized businesses, and state and local governments. And there are a number of different programs, measures that are out there, but we're specifically going to discuss today, at least on my component, two items related to a $600 billion package associated with the Main Street New Loan Facility and the Main Street Expanded Loan Facility. So here's just some general eligibility requirements. And I know something that everyone is focused on, but these loans are not forgivable. So let's just keep that in mind when we are discussing this program. I know that the big part of the PPP program, the Paycheck Protection, was the fact that, as we like to say, there's some free money involved. These programs do not contain that. You are still eligible to participate in the PPP and the Main Street Lending Program, but just keep in mind that these are traditional loans and will need to be paid back. And we'll get into the specific terms on the following slides. There is a restriction if you are participating in the primary market corporate credit facility, which is a new facility that came out to essentially back corporate debt. You won't be able to participate in this as well. I don't know that that's going to impact a number of you, but if it does, definitely reach out to your advisors and get more advice. Some overall limitations: the borrower limits, whereas the PPP and the SBA loans, the EIDL loans, those were limited to generally a 500 employee threshold. This one is much bigger in that it goes from 0 to 10,000 employees. So we'll be able to cover a lot more potential borrowers. So it's 10,000 employees or up to 2.5 billion in 2019 annual revenue. So that seems to capture a large part of what we're calling small to mid-sized businesses. Couple other specifications here. The borrower must be created or organized in the U.S. or organized or created under the laws of the U.S., have significant operations in the U.S., majority of the employees in the U.S., and importantly, have been in good financial standing prior to the outbreak of this unfortunate pandemic. The comment period associated with these programs is essentially supposed to end today, so we will get some more clarification. There are, as to be expected, a number of questions that are out there in terms of significant operations in the U.S. and employees, how to foreign-owned businesses. But for now, these are the rules as they're stipulated. So and again, there's two facilities. You can participate in one or the other, but you can't participate in both. The difference being that the new loan facility is for new loans that originate on or after April 8th, 2020, whereas we'll see on the expanded loan facility that those are going to be for borrowers who already have existing loans. There's a 4-year amortization period with a 1-year deferral. The interest rate is basically based on, what we call the new LIBOR, kind of the secured overnight financing rate, which as of now is fairly low, plus 250 to 400 basis points. So you're looking at it anywhere from, I would say, 2.5% to 4% loan. Again, we'll see, once the actual the new information comes out, if they change that, but that's what the law states right now. There are minimums and maximums, and under the PPP, the loan program was a formulaic computation. This is, again, a bit of a formula, but there are minimums and maximums here that we've listed. The minimum being 1 million. The maximum, the maximum is going to be the lesser of 25 million, or a multiple of your EBITDA. And EBITDA is your earnings before interest, tax, depreciation, amortization, basically kind of not a cash earnings, if you will. We'll see, how the EBITDA gets defined. If your 2019 EBITDA was impacted positively or negatively by a non-recurring event, whether or not that looks to be normalized. But again, once the rules, the explanations come out, we'll see. No prepayment penalty, but there are servicing and facility fees, which could be anywhere from 2 to 2.25%, depending upon how long the loan is outstanding and whether or not that becomes the borrower's responsibility or the lender. We'll see. These are bank-driven. I keep referring back to the other loans where they were through. This has nothing to do with the SBA. It's a completely different program, so just keep that in mind as well. So onto the expanded loan facility. This basically, as I was saying, increases the size of loans. Prior slide, please. This increases the size of loans outstanding prior to April 8th, 2020. So this is basically for borrowers that already have debt on the books. Same amortization period, same adjustable rate. Interest-wise, the minimum again is $1 million, so you have to take out at least $1 million. However, the maximum loan amount here is again put out. It's up to $150 million, and it comes with an EBITDA component as well as an existing, outstanding, and uncommitted but undrawn bank debt, as the other program had as well. And basically, that we think is referring to if you have a line of credit or a loan that's outstanding but you haven't drawn down on it. It's that piece that's going to be the function of the calculation. Again, no prepayment penalty, but there are servicing and facility fees. So just keep in mind, if you're going to enter into this, there are these clarifications, and because the minimum, not the minimum, the maximum amount is fairly formulaic as well. You're definitely going to want to work with your advisors to make sure that you understand, kind of what your maximum loan balance could be in this situation. Okay, so now we've gone through eligibility and the details of the loan. There are certain attestations and certifications that both the lender and the borrower are required to make, some of which are the same, but it's important to note that both the borrower and the lender will be making these. Essentially, what the first one about the borrower is, the intent of these loans is to maintain your business and keep your payroll and keep your people employed, similar to what the other programs had sought out, and that they want to keep businesses afloat. So you're not allowed to use the proceeds to repay other loan balances or lines of credit, nor can you repay other debt of equal or lower priority in general until this loan is paid off. So there are some restrictions in terms of what funds or how the funds are going to be used. Eligible borrowers also must say that they are in exigent circumstances, so their business was negatively impacted by this unfortunate pandemic. You're going to use the proceeds to maintain payroll, maintain your employee count, meet that EBITDA condition that we talked about before in terms of how the actual loan itself is computed, so that it gives the impression, at least for now, that they're going to have to be positive earnings. But we'll see how that actually comes to bit when the actual final rules come out, although they did want borrowers to be in good financial standing. Whether that means your 2019 income or overall, again, we'll have to see. And then there are some limitations relative to compensation, stock repurchases, and other capital transactions that we'll discuss momentarily after we talk about how the lenders are impacted on the next slide. So similar to the borrowers, the lenders must also say that the loan will not be used to repay or refinance pre-existing loans or lines of credit. So again, this is kind of a two-pronged, both-side approach. And again, they will not cancel or reduce any existing lines of credit. And here again, and I'll mention that the borrower and the lender, again, are going to go back and certify that there aren't conflicts of interest prohibitions as specifically referenced in the sections of the CARES Act. The section is 4019B, which ultimately points to 4003 and 404 of the CARES Act, which are discussed on the next slide. So this is what we were talking about. If you do enter into this program, you're going to be prohibited from certain stock buybacks and other equity repurchase transactions. And this type of program right now is not just for corporations; it's for all types of entities. So how this would apply to other non-corporate entities in terms of stock buybacks and certain other equity repurchases, as well as dividends or other capital distributions with respect to common stock, because common stock is a corporate concept. Partnerships and other types of entities aren't necessarily going to have this, so how this applies to them remains to be seen. As I was saying before, workforce retention, payroll, maintenance, that's really the key. That's really the goal. That's what they're looking for here, to keep people employed. With that in mind, this is saying you have to retain basically at least 90% of your workforce that existed as of February 1 and retain at least 90% of the full comp. And it says you will restore all comp and benefits no later than 4 months after this crisis is deemed to be over. And I just want to really reiterate, this is what is in the act as of now. Once the comment period ends and there's other interpretations, some of these rules may be softened, because it also mentions that you're essentially going to keep jobs onshore until 2 years after the loan is repaid. So this is what's in the act, but as we've seen from the PPP and EIDL programs, there have been interpretations that have softened or changed some of this. So this is the law right now. But again, if you're interested in this program, there is no means to borrow against it yet, but you'll want to keep that in mind. And we as a firm will plan to update you, but this is the information that we have right now. So, and on the next slide, we talk specifically about the compensation limitations. In that, depending upon what certain, and it says officers or employees, also that's a corporate concept, at least officer is. Partnerships and other types, they don't have officers. So how that impacts this calculation remains to be seen, but basically, if you're making between these salary levels here, 425 to 3 million, your comp is essentially going to be frozen until after a year after the loan is repaid. Severance is impacted too, but it really impacts officers or employees with compensation excess of 3 million, in that their actual salary is going to be reduced in this instance, until the loans are paid off for a year. There are certain exceptions to the salary limitations for certain collectively bargained salaries, and additional restrictions exist as well. The borrower cannot be a debtor in bankruptcy, have to honor existing collective bargaining agreements, remain neutral in union organizing efforts. And again, these are the rules as they're written right now. If they do change, we'll update you. I think, the overall goal here is, if you do feel that you're going to fall under this program, get your ducks in a row in terms of what you believe your EBITDA calculation is, and then once the Federal Reserve and the banks determine exactly how the process will go, you can be ready to apply. But these are kind of the main points as we know them so far. So with that said, I'm going to turn it back over now to Josh, who's going to discuss key PPP and EIDL takeaways and consideration. And pun intended, take it away, Josh.
Thanks, Steve. Appreciate it. So certainly, I'm going to start by saying this. If you have not applied yet for the PPP loan, as soon as this webinar is over, your best bet is to get on the phone with your banker, get online, and start applying, because as we'll see in a few minutes, this money is drying up very quickly. So just wanted to take a few minutes to update you all. There have been some changes since we last spoke about a week ago. Some more things have been clarified. So if you have not applied yet, this information directly impacts you. So just some general takeaways and considerations. Applicants are eligible for loans under both the EIDL and the PPP program. Also, having loans under these programs does not affect your ability to apply for the Main Street lending program that Steve just discussed. Again, remember, it's based on certain available borrowing capacity and other EBITDA requirements as well. And also, too, there's been some more information that's come out, especially with regards to these loans and interactions with other deferrals, credits, and incentives. A lot of questions, that have been clarified surrounding the employer's ability to defer the FICA tax during the period where the loan is being spent. Once the loan is ultimately forgiven, you're no longer able to do that anymore. But that's just one of the many credits and incentives in the CARES Act. So before you make any big decisions, as Todd mentioned in the onset, it's really important to consult your advisor, consult with your payroll company, consult with your banker, because a lot of these things are very much intertwined. And again, we want all you folks to be in the best financial position available. So just to recap, the EIDL loan, the economic injury disaster loan, again, it has a $2 million maximum loan balance at the SBA's discretion. There is a $10,000 advance, which, due to the sheer volume of applications and money drying up, they have limited folks to receiving $1,000 per employee, up to 10 employees. So if you were to apply for the grant or the advance and you only have 4 employees at the measurement date, you're only going to be advanced $4,000. There are net worth and taxable income limitations. Remember, the net worth was $15 million and the taxable income was $5 million each year for the previous 2 years. It is a very detailed application process through the SBA for this program. In addition, there are guarantees and other collateral requirements that you do not have with the PPP program. With this loan, there is no forgiveness aspect to it, other than the potential $10,000 advance. and the loan is subject to a 30-year amortization. The interest on the loan for not-for-profits is 2.75%, and for for-profits, it's 3.75%. Reviewing the PPP loan, the Paycheck Protection Program loan, it has a maximum loan balance of $10 million. And again, remember, that is subject to a formula. There is the potential here for forgiveness of, or if not all of the debt. As I mentioned before, there was some additional clarification that did come out since we last spoke. Most notably was only the cap on salary of $100,000 plus benefits. If you remember, one of the things we had discussed was it was unclear at that point if it was going to be $100,000 all in salary plus benefits, or it was going to be $100,000 capped, $100,000 of salary capped, and then adding all the benefits. So this is certainly a plus for all of us, as it does create the opportunity to get more money. Also, too, it does allow you to include the self-employment income of general active partners in a partnership. Important also to note that individual partners in partnerships may not submit separate PPP applications for themselves. So if your self-employment income is included in the partnership application, you should not be filing one for yourself. Borrowers may use payroll from calendar year 2019 or a trailing 12 months. This was a question we had gotten many times. Originally, the SBA application required borrowers to provide their payroll costs for the calendar year 2019, which was different than from how the law was written, which said a trailing 12 months. You now have the ability to calculate it both ways and put forward certainly the payroll costs that provide the best benefit for the company. There are differences, and we're going to talk about these in a minute, differences between the use of funds and funds eligible for forgiveness. The application process is completed through SBA designated banks. At this point, some of the banks are closed with respect to applications. There are some non-bank SBA providers. So again, if your bank is closed out, you certainly want to ask them for a recommendation as to who they know is still accepting applications. The PPP loan does have a 2-year amortization period at a 1% interest rate. It is important to note, as some of you are receiving your loan documents, the interest does begin accruing the day that the funding is complete. However, payment does not begin until 6 months later. Also, too, if the entire loan is forgiven, then the interest will be forgiven as well. There was some new guidance that came out late Monday night with respect to those individuals who filed for Schedule C on your personal tax return. You must be operating as of February 15, 2020. You must also plan to file the Schedule C with your 2020 tax return. That is a requirement. Again, if you do have employees as part of your Schedule C, you will be required to submit the related payroll tax forms, in addition to support for any retirement or health insurance contributions that the company does make. Here, the owner compensation for loan forgiveness is limited to 8 weeks of 2019 profit. And if you don't have payroll, some of the things that you will have to submit are your 2019 Schedule C and essentially the other forms below to support your ask. So, as I said before, the money is running out. This stat, which we had received yesterday, is already outdated, as you could imagine. So as of yesterday at this time, the SBA was reporting that over 1.292 million applications have been approved, totaling over $289 billion. So at this point yesterday, there was about 60 billion left. As you remember, there was 349 billion committed to this program. If you watch the news this morning, they're going to tell you there's even less. So again, it creates urgency. If you have not applied yet, that you certainly make it a priority. I'm going to turn it over to Todd now, who's going to talk to you about what it is we know about loan forgiveness. Go ahead, Todd.
Thank you, Josh. So this is the slide that everyone's been waiting for. So if you did not apply yet, we are encouraging you to apply. And if you've received a notification that you've been approved, then you're going to want to listen to the next few slides that we're going to chat. The all-important loan forgiveness, what makes this, what we originally spoke about a couple of weeks ago, free money. Now, folks, we're going to tell you what we know. We're going to give you a nice, I think, tracker example of how you should be tracking this. And then we're going to tell you a little bit about the documentation requirements. And then Josh is going to come back in the end and tell you what we don't know, which I think is important as you're doing your planning. So first and foremost, understand that the SBA clarification of forgiveness is expected via additional guidance, which means that we will be updating you as we find out from the SBA what they mean. Some folks are calling this whole loan forgiveness an enigma, and there certainly is parts of this that are a mystery, but there are some things that are really clear. So let's talk about that. First, the focus on loan forgiveness is primarily addressed towards payroll costs. Payroll costs include compensation of employees whose principal place of residence is the US, which is wages, salaries, commissions, or similar compensation. Payroll costs also include payment of vacation, parental, family, medical, or sick leave, allowance for separation or dismissal, and payment for provision of employee benefits consisting of group healthcare coverage, including insurance premiums, retirement, payment of state and local taxes assessed on employees' compensation, and per the SBA interim final rule, which is an oxymoron in and of itself, not more than 25% of the loan forgiveness may be attributable to non-payroll cost. So only 25% can be used for forgiveness purposes for the following payments over the 8-week period following the date of the loan. Payments on interest on mortgage obligations incurred before February 15th, 2020. Rent payments on leases entered into prior to February 15th, 2020, and or utility payments under service agreements entered into prior to 15/2020, and utilities include payments for electricity, gas, water, transportation, telephone, or internet access. We also see in the law and also in the additional guidance, the whole point of this was to maintain your workforce, to bring people back. So part of the loan forgiveness could be reduced if your headcount decreases. So the loan amount is eligible for forgiveness. It can be reduced, but not increased by this lovely two-part formula. Part one, the average number of full-time equivalent employees during the 8-week period beginning with the date of the origination on the loan. B, the average number, and this is at your discretion, of the FTE employees from February 15th, 2019 through June 30th, 2019, or you get to pick January 1st, 2020 through February 29th, 2020. And part two of this, the C, is the Paycheck Protection Program loan used for the eligible costs. So the formula is A divided by B times C. The other part of this reduction may result from a salary decrease. Again, whole point is to keep people employed and at the levels that they were working. So the loan amount eligible for forgiveness may also be reduced by decreases in salary and wages of any employee if the decrease occurs during the 8-week period, beginning with the date of the origination on the loan, and the decrease is in excess of 25% of the total salary or wages of the employee during the most recent full quarter during which the employee was employed prior to the commencement of the 8-week period. And employees who received annualized wages or salaries in excess of $100,000 are excluded. So there's some exemptions from these reductions that you should kind of keep in mind. They're available if during the period from February 15th, 2020 through April 26, 2020, there's a workforce or salary reduction that meets the criteria on the earlier slides, but the borrower restores the FTE employees to the pre-February 15th, 2020 amounts by June 30th, 2020, and/or the borrower restores the reduced salaries or wages for employees to pre-February 15th, 2020 amounts by June 30th, 2020. And now we're going to show you an example of how to calculate the forgivable portion of the loan based on what we know now. Okay, so this is our lovely schedule. Has a few tabs to it. We're going to start with the first tab of allowable uses of proceeds. I can't take credit for this beautiful tracker, and the person responsible wants to remain anonymous out of fear that you will be directly emailing that person for the spreadsheets. So the PPP expense tracker. The first thing that we want to note is what's the allowable use of the funds. Payroll costs. 75% of the loan proceeds has to be used for payroll costs. So that includes, again, salary, wages, commissions, tips, or similar compensation. Employee benefits, including costs for vacation, parental, family, medical, or sick leave. Payments for group health care benefits, including insurance premiums. Payments for retirement benefits. Payments of state and local taxes assessed on compensation. Also, again, we're talking about the allowable use of funds. Payments of interest on any mortgage obligation, which shall not include any prepayment or payment of principal on a mortgage obligation, rent, including rent under a lease agreement, utilities, and interest on any other debt obligations that were incurred before the covered period. Again, this is what is allowable, the allowable use of the funds. So the next tab, we're talking about what is eligible for forgiveness. And you'll notice in this slide, we're going to go down it in a moment, we're covering 8 weeks. And obviously you can make this any way you want, but this is the way that we like to kind of keep track of it. The first section relates to the salaries, wages, or tips. It's capped at $100,000 on an annualized basis, or $5,384.62 for the 8-week period for each employee. Don't forget the 62 cents. And you see there's the employees listed down there, which will give us the total gross payroll for that date range. The next section is the state and local taxes assessed on compensation of employees. Gives us the state and local tax number. Then the payment for the provision of employee benefits, including all the various costs. Again, by employee, the total employee benefits, and then a little bit further down is the employer contributions to defined benefit or defined contribution retirement plans, giving us, as you see in line 38, the total payroll costs. Remember, the whole purpose of this loan in the mind of the government was primarily related to payroll. Next section relates to the utility expenses. And you can see here, we're tracking it by week. These are service agreements that were entered into prior to February 15th, 2020, electricity, gas, water, transportation, etc. So in line 47 is your total utilities. The next section, starting with line 49, is your rent expense, obligations to lease agreements enforced prior to February 15th, 2020. Line 53 is your total rent expense, followed by interest on covered mortgages. Again, different mortgages, the interest expense, and that calculation on line 61 is your total payroll expenses. You'll also note on the following that 25% of the loan forgiveness amount can be for non-payroll costs. So in the next section, we're actually showing the limitation of non-payroll costs. You have your total SBA loan received, the allowable non-payroll costs as a percentage, and the non-payroll costs above. And if the amount is negative, this is a reduction in the forgivable loan amount, and this amount should be carried to the debt forgiveness limitation calculation, which is on the next tab. So this is all formula driven, folks. The potential forgiveness of debt due to the expenses incurred. Carried forward on line 7 would be the payroll costs, the 8 weeks. Line 8 is the utilities, 9 rent, 10 interest. 11 is the reduction in non-payroll costs from eligible for forgiveness tab if the amount is negative. And that leaves us now with our very first number, the potential forgiveness. That would be great if we could just stop there, but we can't. So the next 2 sections is the reduction due to the reduction of employees. You're starting with your average number of FTE employees per month employed during the covered period. You are also including any employees hired back before June 30th, 2020. Remember, we said that's something that if you did that, will make you whole. Coming back to an adjusted average number of FTE employees per month employed during the covered period. That then is compared to the average number of FTE employees per month employed during the period of February 15th, 2019 and ending June 30th, 2019, or the average number of FTE employees during the period of January 1st, 2020 to February 29th, 2020. And then you have, again, the potential forgiveness. But then we have another reduction due to the reduction of employees, revised potential forgiveness of debt on line 28 before the reduction to the reduction of the 25% salaries. There's a calculation of those employees whose salaries were reduced by 25% or more, and then you have a revised potential forgiveness of debt. We like to, in the last section, show what amount of the loan was received, and then the forgiveness per the calc, and then the total SBA loan net that needs to be paid off over the 2 years at 1%. And as Josh mentioned earlier, that 1% interest starts once you receive the loan amount, and it is qualified, the interest is qualified as well as the forgivable part of the loan after the 8-week period. So let's go to the next slide that talks about documentation. So the number of FTE employees on payroll and pay rates. These are things that you're going to need to provide to the bank in order to demonstrate that the loan amount should be forgiven. Payroll tax filings with the Internal Revenue Service, state income, payroll, and unemployment filings, canceled checks, payment receipts, transcripts of accounts, or other documents verifying payments on covered mortgage obligations, covered lease obligations, and covered utility payments. Let me just state here, it would be a good idea, besides using this tracker, to be gathering this information as you're going along, so that after the 8-week period is up, you can present this to your whoever's lending you the money, so that they then can in turn review it and send it to the SBA or certify to the SBA. Also, the certification from an authorized representative that the documentation presented is true and correct. You swear to tell the truth, the whole truth, and nothing but the truth. And the amount for which the forgiveness is requested was used to retain employees or make interest payments on mortgage obligations, rent obligations, and utility payments enforced prior to February 15th, 2020. And then the lenders have 60 days from the receipt of the documentation to render a decision. Now, again, I'll say this one more time. There is still more information that the SBA needs to clarify. So this is to our best knowledge now. And so I'm going to turn it back over to Josh, who's going to tell us a little bit about the things that we don't know. Josh?
Thanks, Todd. So certainly listening to this, I'm sure you all have a lot of questions. We have a lot of questions too. We've done our best to put forward to you what it is we know, but we just want to put out there for you too. This is what we believe to still be unclear and need further guidance. The first point I'll make, and it's not on here, is will they put more money into the program? I'm seeing signs and articles that the PPP is out of money. So, will the folks in Washington figure out how to put more money into this program? Two is, are the costs for the 8-week period to be determined on a cash basis or an accrual basis? If you read the law, there's words like payment in there, but again, it's not 100% clear. And to folks who run businesses, this, the timing as to when you receive the money could have a direct impact on your ability to spend on certain expenses, most notably payroll. Another question is, it's clear that at least 75% of the loan proceeds shall be used for payroll costs, but what happens if I spend less? There's certainly conflicting articles out there. Some say that if you don't spend 75% on payroll costs, the whole loan won't be forgiven. But others say, is that really the true spirit of the program? That certainly remains to be seen and should be clarified quickly. Other questions we've gotten is, should full year bonuses and/or year-end profit sharing contributions be included in the forgiveness calculation, or does payroll and compensation for the 8-week period really mean payroll and compensation for the 8-week period? You heard Todd before talk about rent under a lease agreement. Well, does that rent cover only costs for facilities, or can you include equipment rentals as part of the rent eligible for forgiveness? Also, too, how is full-time equivalent calculated? We see the term, we see the period where we have to compare people, but nowhere does it say how a full-time equivalent is calculated. Is it 30 hours, 35 hours, 40 hours a week? We are not 100% sure there. Also, too, how are non-COVID-19 reductions in workforce and/or salary treated for purposes of the loan forgiveness reduction? Again, remember, not all terminations are because of not being able to work. How does that impact the calculation? Going back to the point above, will the formula for salary reduction be pro rata adjusted? We're not 100% sure. with that either. And then do the exceptions for headcount and or salary reduction allow for a replacement of the terminated worker, right? So all we know is that if you had employee A during the one period, they're looking at employee A for the same period now. So that is a question. Also, too, we've had a lot of conversations. A lot of businesses are closed. Unfortunately, a lot of businesses are working at half staff, trying to, adhere to social distancing rules and trying to make environments safe for their workers. The big question I have is, will they extend the 8-week program? And then the last point, and again, this is just a handful. There's a lot more. Is we made reference before to that the head count being restored by 6:30, but how is there a time period for which those employees have to be rehired, or can I just bring them back on June 30th? So that is certainly a handful of the questions that we have. Just want to bring everyone up to speed too. We will be holding weekly webinars going forward to discuss these changes as more information is clarified. So don't think you're out in the dark. You come back next Thursday at 10 a.m. and we'll be here for you. So certainly go ahead, put that on your calendars. We're going to be with you for sure for the next 8 weeks. And then just a reminder too, for additional questions, please email covid19@sacsllp.com. We do have another webinar upcoming on Monday with respect to state and local tax impact and implications from COVID-19. And of course, always feel free to visit our COVID-19 Resource Center, found at our website, sacsllp.com. So I want to thank all of you for attending today. I want to thank my panelists. Be safe, be healthy. We'll see you soon. Take care, everybody. Thank you for listening.